Good morning. Welcome to the sixth episode of Capitally Insight series. Today's topic for discussion is Global Trends 2021. A year ago, the biggest question for investors was how quickly the global economy would recover from the depths of COVID-induced recession. Today, the answer is clear. After the largest drop in quarterly GDP on record, world GDP is now back to pre-COVID levels. Now, the debate is whether this recovery is a long-term sustainable trend. There are three factors to our mind which support a strong growth outlook. First, COVID-driven economic health crisis was quite different from the global financial crisis, which was born out of excessive private sector leverage. Second, policy makers around the world have responded to the pandemic's economic impact very swiftly and very aggressively. Finally, in the biggest departure from prior recovery, policymakers want to see inclusive growth before they put the brakes on the stimulus. It appears to us that this is definitely a recovery which has staying power. Economists around the world are predicting something like a 6.5% GDP growth. And growth is always good for us as consumers, business owners, employees, and of course, as investors. In today's session, we will throw the spotlight on some key global trends which are shaping the global economy and, as a consequence, the global investment scenario. To help us better understand these trends, we have with us Swaroop Mohanty, CEO, Mirae Asset Mutual Fund. Swaroop is a veteran of the financial services industry with over 24 years experience. And Mirae Asset Mutual Fund is a much accoladed and awarded fund house. Thank you for joining us today, Swaroop. Welcome to the discussion.
Thank you so much, Sapna, for having me. It's an absolute honor and pleasure to be with you and your investors. I hope we have a good and meaningful discussion going forward. I'm really looking forward to it.
Thank you. So before we start the discussion, I'd like to mention that we'll have a 10-minute Q&A towards the end. Please type in your questions in the Q&A section at the bottom of your screen and address it to the panelists. Also, in today's discussion, we have two opinion polls, and I'd like to start the session by triggering off the first opinion poll. So the question on your screen is, are you bullish on equities? And the choices are yes or no. Okay, so the vast majority of our audience is quite bullish. And that links into the first trend that we want to highlight, which is the globally surging economies. And what does this imply for global equities? So in a little more, less than a year, the global economy has rebounded from one of the worst recessions on record. Globally, equity markets have surpassed all expectations. None of us had anticipated that we would be at these levels today. Now, surveys around the world are showing that the investors are still looking for a bullish equity market this year. The volatility indices around the world are trending downwards. The graph that you see on your screen is the global risk appetite. And you can see that the index has now reached euphoric levels earlier seen only before 2008, when the global financial crisis was just about to happen. So Swaroop, what are your thoughts on this? Do you subscribe to a bullish outlook?
Sorry, I was mute. Sorry, my apologies. Yeah. So I'll start again. So on the global front, Sapna, if you see right now, there are three key monitorables from the economic recovery point of view. One, obviously, is the pace of vaccination. Second is the pace of the economic revival. And the third is very important because the monetary policy stance of various central banks come into play. On the vaccination front, the developed countries have already taken the lead, and the pace is increasing as we speak. We're seeing a very similar trend in India too, where suddenly in the last 15, 20 days, the pace of vaccination has only increased. And that goes for the rest of the world. I was speaking to my friend in Canada yesterday, and she was telling me that they're attempting to vaccinate 75% of their overall population by mid-year, by September, October. That's how it's picked up. So when you look at the developed economies, they've also already seeing a revival, and that can be clearly seen from the various high frequency data points like, say, the mobility index or the oil consumption, etc., especially in the US and the Europe. If you look at the GDP estimate, that's something which you hinted at, we believe that, and these are facts and figures, that the global GDP is expected to bounce back from minus 3.3 in 2020 to 6% in 2021, and then moderate to around 4.4 in 2022. If in India we see the restrictions starting to ease on the larger part of the economy, we will also see a similar sort of reversal is our view. Coming to the monetary policy, which is very important by central banks, one can expect the loose monetary policy in the near term, at least till the recovery is on a firm path. However, if the inflation persists, then as suggested by the Fed, we could expect some policy tightening. And that's something which we were discussing just before this call started. But when it comes to the outlook on the Indian equity, and there is a reason why most of the people polled yes to the poll, it is important to first give the context. The domestic economy, even before the COVID wave, was on a relatively weaker footing for various reasons. We can discuss that separately. But however, given the current lockdowns in the second wave are not as severe as that of the first wave, or you can also say that by the time the second wave come, we had upgraded to COVID around us. It was not the same as the first wave. And yes, as you rightly said, the markets clearly show investor bullishness that was shown in your graph, and of course our poll too. See, typically equity markets generally tend to be the leading indicator, and current resilient markets do imply that the investor optimism on the corporate earnings front is there. They believe that there will be a recovery, hence there is money. And this is for investors across segment. It's not just, say, the retail or the institution, the FIs too, across segment. While it is always difficult to predict more on a short term, we believe that India is, and we've written that also, that we are in the cusp of a multi-year growth revival. Make no mistake on that. Given the multiple drivers that are around us, which will lead to a certain mean reversion to our growth rates. There was a predicted growth rates. These include, say, the low interest rates, the acceleration in manufacturing exports, buoyancy in the rural sector, and there is a definite consolidation to stronger players. That's the COVID impact, where the larger or the structural players have come to play. There is a definite shift from labor-intensive companies to automated companies. That has happened, and those companies will clearly take the lead post-COVID too. For the remaining period of the calendar year, hopefully the third wave will not come. That's our belief. Hope it doesn't come. And we can potentially see some positive news across all fronts. And vaccination, as we speak, is ramping up, no doubt about it. Therefore, there is a certain belief that the consumer spends on goods and services will return to normalcies, though at different paces. When you look at the current wave, it will definitely impact the near term, that is the first quarter of financial 22 year earnings. We do expect a strong earnings recovery post that. The consensus estimate, which is published data for Nifty earnings, showed around 22% earnings CAGR for the period 20 to 23. In 3 years' time, we're talking about earnings of around 22%. But as I said, there is a definite support from the improving global economy, which will help our country in exports. With lower interest rates and hopefully a good monsoon, this will help a faster recovery as well as help to sustain markets from a medium-term perspective, is our house view.
So good to hear that bullish outlook. The second trend we would like to talk about is inflation. So when coronavirus hit, policymakers felt confident that printing and borrowing money at a record pace won't stoke consumer inflation. And a lot of data shows that actually inflation has been benign for most part of the world for over a decade now. So Swaroop, what are your thoughts on this? What is stoking global inflation?
See, inflation numbers across the globe, as you rightly said, have clearly reached a multi-decade high. While policy activism is broadly at play, it is more driven by some idiosyncratic factors, which are mostly, say, the widespread shortage in labor, which is natural to the environment, and inputs and logistics. On the oil front, too, the supply side discipline is also playing a very large role. Let's add that to the whole thing. Interestingly, and this is what is a very, very interesting factor, there is a rotation of demand towards goods and housing as large income transfers are very used to buying larger homes and home improvement. This is a fact which is not only in the globe, we are seeing that in India too. See, this is, I believe, a historic aberration. Normally, it does not happen because typically in crisis is goods which take a bigger hit than services. Given that the large ticket sizes are moved and there's some very phenomenal money involved in this entire thing, this is an aberration. This as a result has turbocharged commodities, and the US services and the housing sectors typically have not been spared either. Once things normalize, this supply shock could fade, and with the lockdown sort of easing, there could be rotation back to services from goods. And that's what normally happens. It must be noted at this moment, if I were to look at it from a far broader perspective, that traditional demand drivers like inflation, and say the private sector credit cycles remain weak globally due to the underlying impact of COVID. And the utilization levels as a result are still slow. And there is still a lot of, labor market slack across the globe. Hence, it's perhaps a little too early to worry about a very large inflation spike. It appears to be transitory as of now, is our view, and only time will tell whether it is structural. It's too early to take a call of whether it's going to be structural or not.
Understood. So the third trend we would like to put the spotlight on is global liquidity. So now, while talking about inflation, bullish investment scenario, one of the common themes or common factors that always gets talked about is the easy money, the global liquidity. So central bankers have flooded economies with massive amounts of global liquidity. To give a sense of the scale, the trillions of dollars of bond purchases that central bankers did last year was many multiples of what they had done in 2019. The graph that you see on your screen is the Fed's total assets. And you can see the steep rise that has happened over the last 1.5 years. Now, Swaroop, there has never been so much global debt. We are clearly in uncharted territory. So could you share some insights on the likely implications of this mammoth global debt on developed emerging markets?
Sapna, you said it. The right word is we are in an uncharted territory as far as global government debt and monetary stimulus is concerned. See, the current stimulus is different from what we saw in the last decade. In the last decade, central bank balance sheets nearly quadrupled. However, instead of inflation, we witnessed deflation, right? This can be attributed to continued deleverage by the private sector and governments too. They refuse to lever up, leading to a phase of weak demand. However, in the recent stimulus, if you see, the governments are practically extracting the central bank liquidity and plowing the same back to the economy. If you look at the developed market stimulus, this will lead to tailwinds from emerging markets in the form of exports, is our view. But if this is taken too far, then these policies could lead to higher inflation. But when you look at the current backdrop, these policies are quite welcome. And we are still very far away from worrying about high structural inflation. Coming to reversal of expansionary policies, given the fresh memories of the taper tantrum, we don't expect any knee-jerk action from the central banks and expect them to prepare markets in advance. RBI too, if you look at the recent Monetary Policy Committee, as expected, kept the policy rate and stance unchanged. We feel the RBI is rightly focused on growth rather than being able, or it's overtly worried on supply-led inflation. Their approach is keeping, sufficient liquidity and follow a wait and watch policy on the inflation, whether it is transitory in nature or structural. Right now, they will wait and watch. and this loose monetary policy will prevail for some time to come.
Okay. The fourth trend that we want to highlight is dollar weakening. So as the US has rolled out trillions of dollars of stimulus, their debt to the rest of the world has been inching up. And now their debt to the rest of the world has reached 50% of their GDP. So today the dollar is the undisputed reserve currency. But what happens when the rest of the world loses the confidence in their ability to pay their bills? So how do you see this, Swaroop? Is this dollar weakening a long-term trend, or do you think it'll bounce back? And what are the implications of a weakening dollar?
We feel the current policy setup pursued by the Fed and the US Treasury does point towards a weaker dollar over the medium term. As you rightly said, dollar is the reserve, and with it being the global reserve currency asset, it definitely its weakness augurs well for risk assets, especially emerging market equities, commodities, value, cyclicals, gold, etc. It falls in the same bracket of riskier assets. But it's a boon for emerging markets. It makes it easier for the emerging market countries to repay their debt or service their debts, which has a cascading effect on the others, on the overall economy of these countries. Hence, we believe that a weakening of dollars always means good news for emerging market. It also facilitates strong global growth revival, as strong USD flows allows emerging markets policymakers to reflate their economies as well. More importantly,
Okay.
one must keep in mind that it drives higher global trade and emerging market exports always, despite, say, the appreciating currencies. Some may worry about the appreciating currencies, but in spite of that, the global trade and emerging markets always benefit in exports as global demand and the sentiment sort of improve. It's good for us when that happens.
Okay. So long and short of it is they've printed a lot of money.
Yeah.
Dollar has weakened, but actually there are lots of positive attributes or multiplier effects of a weakening dollar.
For us, it's good.
Okay. The fifth trend we would like to put the spotlight on is the commodities revival. Now, commodities, actually, I read somewhere that since the beginning of 19th century, in real terms, adjusted for inflation, have actually been trending downwards. But this long-term trend downwards is punctuated with decades of commodities boom. So now the graph that you see on your screens is the CRB Commodities Index. And in the last 1 year, this index has increased by nearly 50%. And year to date, it is up by nearly 26%. So Swaroop, do you think that we are entering a decade of commodities boom? Or do you see this as a temporary phenomenon?
Interestingly, Sapna, commodities are unique in the sense that their end consumer demand may not vary significantly, but the prices fluctuate more primarily due to changes on the supply side. Right? That's why it makes it so unique. Either there could be, a bunched up capacity additions, or at times some disruption in some large suppliers, whether it's mechanical or sometimes it is nature driven too. Hence we believe that forecasting commodity prices may be a bit futile. A lot of other factors come in, but each commodity type, whether it's metals, oils, or agriculture, will have their unique factors which influence the price movements, as you have rightly shown in the graph. The sustained China demand and its plan to curb pollution, as well as, say, couple it with the big capex program by the US, could keep the metal price higher in the medium term, and there is so much demand for it at the near term. On the oil front, in the near term, as the economies open up, we see demand growth, and this coupled with when you couple it with the supply, may help the prices sustain in the near term. However, there is a very interesting factor when it comes to the oil. There is a systemic shift from the world to reduce carbon emission. And there is the emergence of the electric vehicles across the world. And there's no denying the fact that clean disruption is the top of the hour, and people are very conscious about it. In the long run, this could keep the oil prices in check. Just imagine the economies are being run by oil, a lot of it. Suddenly, if the dependence on oil decreases, that will be a very interesting phase, and I'm waiting and watching as to how the world will adapt or change, take to that change. But make no mistake, this is an impact which will come sooner than we think.
Okay. So the sixth trend we want to highlight, or rather the issue we want to talk about, is the emergence of emerging markets. So in the recent past, every fund manager call that we've attended, any research reports we look at on global markets, in everywhere, there is so much of focus and talk and analysis on emerging markets. So at present, the US is playing an outsized role in driving the global growth. But obviously, the same factors which has helped US are also going to impact emerging markets in terms of faster vaccinations, in terms of opening up of lockdowns. So emerging markets are already seen to be benefiting from strong external demand, and high growth rates are already providing tailwinds to the economies of the emerging markets. In fact, analysts are predicting something like a 7.2% GDP growth this year. So, Swaroop, in your opinion, what will drive growth in emerging markets further? And do you think this is the decade of emerging markets?
Very, very pertinent and the right question at this moment of time. Because see, typically and essentially for emerging markets, and for that matter for any country in general, there are two growth drivers broadly. One are the exports, and the second are the domestic credit cycle. In the 2000s, we had, say, those times we had a combination of both. But with significant gain in, say, exports for as emerging markets, net trade balance sort of increased from 2% of the GDP to 8% of the GDP. And this is a mirror image of the widening trade balance in the US too. This is a very healthy business cycle, and the growth typically tends to sustain for longer times, as the emerging markets' current account balances lead to, say, the higher forex reserves, which are invested in turn into the US only, US treasuries. Right. This what happens is this then keeps financial conditions in the borrowing economy very benign despite rise in leverage, which is, say, it's a kind of vendor financing of sorts. Then, the chain eventually breaks once leverage becomes excessive, as it happened, say, in 2008. That's when it breaks. This in turn, what happened to the emerging markets, they pivoted their growth models from being exporters to consumers, typically reflect on what happened to India. We started becoming a consumption-led economy rather than an export-led economy. And this across emerging markets, the issue with this model, when this happens is that unlike US, when debt and financing costs don't move in tandem, as it does in the EMs, that's the only issue. Hence, every time the Fed tries to raise rates, it causes outflows from the emerging markets, weighing significantly on their, say, the leveraging cycle. However, over the next decade, this should reverse with the US households eventually starting to lever up. I mean, you look at their balance sheets, they are very strong. I mean, post 2008, when people were looking at a US debacle, they actually turned it around. One friend actually told me, do you think 2008 was man-made by the US? I started thinking, because what's happened to US is a complete reversal. And because of that strong balance sheet, they will start levering up and hence providing opportunities for emerging market exports to grow strongly. However, again, let me get back to 2000s. The emerging market credit cycle recovery could take more time given the large scarring of the pandemic. Yes, the pandemic has probably scarred the emerging markets more than it has done to the larger countries. And that's a basic fact which happens. Thus, when you look at the overall emerging markets, we foresee that an export-led investment recovery as compared to consumption-led economy post, say, the global financial. That's the change that will happen. It will reverse now. And the current backdrop of dollar weakness and, say, the rising commodity prices actually augurs well for the emerging market, as we discussed earlier. And we expect that the emerging markets, hence you see all fund managers coming and tell you that the emerging markets will outperform in this decade. Hence, I personally think that the emerging markets should do significantly better as say the global recovery broadens out and the financial conditions continue to be quite benign. That these will lead to benefiting the emerging markets, and it's a structural shift. COVID is a permanent sort of impact, and we will see this trend emerging.
Okay. The seventh trend that we would like to highlight is the global capex boom. So this is again something we've been hearing a lot of fund managers talk about, research reports. Everyone is talking about the capex boom, and businesses across the world are starting to invest in huge numbers. In America, capex apparently is growing at something like a 15% annualized rate. And capex is going both into hard infrastructure like machines, roadways, and also intangibles like software. Globally, forecasts for business investments are quite rosy. Again, as I said, any research report that we look at. And analysts at Morgan Stanley have started using a term called red hot capex cycle.
Correct.
And according to them, global investments will soar to some 120% of pre-COVID level by the end of 2022. So again, very, very bullish talk around this trend. And what I want to ask you is, what is driving this capex boom? What has suddenly happened? And do you see this as a sustainable trend? When was the last time the world witnessed capex at this scale? And what was the impact on the economies and the markets?
Ultimately, capex is very cyclical. Suddenly, one capex comes and that gets outdated, and fresh capex happens. If you look at pre-COVID worldwide, the capex was slowly, reaching a pace of extinction anyway. And then when you couple it with post-COVID and with economies now on a recovery path, demand will accelerate and the capex cycle will come back very soon. And that's what is broadly happening. At this moment, you only said that the large spend plans like the ones which are announced in the US should further support this. Finally, it's US-led economy worldwide. And once US signals something, it goes out a broad signal that, this trend has started, everything is okay, and it has a cascading effect. When say in the current pandemic, in many developed countries, policymakers have essentially underwritten private sector losses. Look at it this way, that the governments have taken that risk on themselves. Thereby, what has happened is it has left the corporate and the households with clean balance sheets. It's not happened in India, but worldwide, that's what has happened. And their ability to spend has suddenly increased.
Yeah.
Right. And you couple that with the rise in demand. So they are ready. They were ready because of this. But unlike when you compare this to, I always go back to 2008 because that was the last sort of crisis. But unlike the 2008, where there were fears around, say, the stagnation, when those fears sort of resurface, this time around it's different. There is active and aggressive fiscal and monetary policies, and those have limited the scarring effects and kept the overall private sector risk appetites buoyant. And that's the significant difference. The corporate sector will do capex when it's confident of its growth prospect. That's natural, right? While the COVID-19 shock, I can say, dented demand everywhere, the global GDP is already approaching almost pandemic path. That's where we are now. We're almost back there. While the growth rate will slow from the reopening heights of, say, 2021, but once, we can expect, once it is back to normal, we can expect global GDP to remain well above the pre-pandemic growth plan. Definitely. I mean, that's what the world is upgraded to COVID and living with life in a very short period of time. Both, when you look at the developed markets, from domestic demand and emerging markets from export perspective would support capex plans. Nevertheless, the pace of vaccination and the sharp increase in inflation could derail or delay it a bit, but it is going to happen once these are sorted out. But what I'm trying to say is, because the governments have acted, the private is now free to start doing its capex. And once they see a bit of growth, you will see very aggressive capex plans. And that's why these predictions.
One of the probably reasons why US and other parts of the developed markets are so aggressively looking at large capex is also probably because of China's huge capex. So it's like one driving the other. and then it has a multiplier effect.
I did hint at it because it affects. Yeah, I mean, let's look at it. There was this National Geographic program, I think 2-3 years ago, where it said if there were 100 building cranes in the world, 52 were in China. That is the
Wow.
capex of China. You know, that
Yeah.
just, I found that statement to be staggering. 52 of the building, 52% of capex or building and infra is happening in China. I mean, that's putting US at a different level and China at a different level. So
Yes.
when China unfolds,
Mm.
the impact or the possibilities for the world are immense.
Yeah, their scale in everything is huge.
Correct.
Yeah.
Correct.
Okay, so this brings us to our second opinion poll. And you see the question on your screen. Do you see a rebound in real estate markets? And while we are waiting for the poll results, I'd like to request you all to please follow the Cap League page on LinkedIn. We would be posting the LinkedIn link in the chat box shortly.
I voted.
So Anubik, can we have the result? Okay, so yeah, 60% are bullish, 40 are still not so bullish. So that links into the eighth global trend that we would like to highlight, and that's on housing demand. So real estate is a traditional hedge against inflation. And in 2020, we see that home prices in virtually all developed markets have been trending upwards. And there are many who believe that this trend is going to continue and there is sufficient headroom for prices to rise much further. So, Swaroop, what are your thoughts and observations on the global pickup in housing demand? And do you see a similar kind of housing demand panning out in India?
Sapna, definitely the global housing has been on a boil. You know, this is primarily due to the combination of, say, the negative real rates and the large excess of savings being used in home development. Like I said in my earlier thing, it's an aberration. People have used this opportunity to buy larger homes, upgrade their own homes. It's a one-off event which is happening at this moment, which is very contrary to what used to happen earlier. This, you know, when you accompany it with, say, low supply, has certainly, and people have stopped building houses because of that. So the supply has shrunk to a different level, say, compared to the pre-COVID sort of thing. So this has flared up housing prices globally. In the near term, it could cool off, you know, as pent-up demand. There was a pent-up demand, and the higher prices, when you combine both input as well as output, weigh on profitability in the near term. But in the longer term, you know, in fact, you know, if you look at some of the readings from the US markets, the housing markets are already pointing to the same, that it could in the near term taper a bit. However, from a medium term perspective, we are quite constructive of that area. You know, when you come to India, we believe all the ingredients for the housing demand recovery are in place. The borrowing rates are at a decadal low. I mean, it's no longer a very high rate, and there could be a possibility that it could go southwards. The borrowing costs, as I said, you know, are very conducive to housing. That's where it triggers housing. And the price, there has been a definite price correction. And you cannot take away the fact that, you know, the RERA has had a definite positive impact on the overall sentiment of the end product of the house that one gets. So in this entire COVID period, we've also seen a similar trend in India. And I can speak for myself in Mumbai, where central Mumbai is a very large place of inventory. There was a distinct correction in the beginning of COVID, and it was all lapped up. Right now, we are actually running short of supply in central Mumbai, and the prices seem to be reviving. So when you look at combine all these low interest rates, there is obvious, like we said, it's a natural hedge. There's a natural instinct for people to buy homes, and of course, RERA coming into play. There is a certain constructiveness or organized factor to the housing sector. Hence, we believe that it is ready for a revival.
Okay. So that's good to hear, because housing has such a big multiplier effect on the economy. There are so many agents who are involved in building a house. So people go and buy a house. So you want an AC, you want a fridge, you want, plumber,
Yeah,
painter.
everything.
Multiplier effect
Yes.
is huge.
No,
And
housing is very interesting. If you look at cities globally and you compare, and typically when you compare it to any large city, look at what's happened in Delhi. I mean, initially when it was say Sector 51 in Noida or say
mm,
Gurgaon, there was this 30-second milestone. We used to plan to go to 30-second milestone. Trust me, recently I passed by it and it was in the middle of the city.
yeah,
When connectivity increases, and that's what Delhi Metro has done to them, and we hope Mumbai Metro will do it to now that it's falling in line with the city. And you look at
mm,
London, people live in the suburbs, that's where they have larger houses. But
yeah,
once you put these things in place, which is happening in India, and that's why we believe there's a structural infra thing in play also, the
mm,
cities can just expand. The center
mm,
of the city then becomes the commercial hub, and the
mm,
housing then spreads further. Unlike, thankfully, Delhi does not have a natural barrier. Mumbai has the sea on one side. There are
yeah,
very few cities like Delhi. So look at the expanse of Delhi, and it can grow anywhere. Manesar is now Delhi. Imagine when I used to work in Delhi and I used to come to your office,
mm,
Manesar was like a holiday destination, right?
yeah.
But look at how it's changed in the last 15 years, and we're ready to witness that in so many more cities. But you have to give a lot of credit to RERA, and if it functions well and is put into place, we could see a good systemic revival, and the prices have tapered too. So we can see that happening, is our view.
In fact, you're talking about RERA. So there are a number of these policies which have been issued in the last few years, which also we find is having a multiplier effect on a lot of things in the economy. So the
Correct.
going goods, yeah, it looks quite conducive for growth. The ninth trend that we talk about, which we are witnessing globally, is the reflation trade. So inflation, we've mentioned, has actually been very benign and has all been nearly been absent in much of the larger world for over a decade. But the so-called reflation trades have become the rage in the recent past. We hear a lot about it as trends in politics, economics, public health come together. And it's a market movement where there are clear winners and losers. So, Swaroop, can you please first highlight the key differences between inflation and reflation, and then elaborate on the sectors which are likely to benefit from this?
Correct. See, a reflation is essentially an early cycle phenomena where both prices and demand move higher, with demand growing faster. Eventually, the prices catch up, leading to inflation, which then invokes strong policy response from the central banks. We are witnessing some of it happening as we speak. Inflation is generally a mid-late cycle phenomena. Yeah. But as of now, while inflation prints have gone higher, I remain in the reflationary camp, as some of the inflation is transitory, we believe, and unlike to involve or say to generate a more material policy response. In a reflationary scenario, riskier assets tend to do well. Typically, that's what happens, with investors mainly focused on valuations and the earnings outlook rather than worrying about balance sheet risks. That's what
Mm,
they primarily focus on, whether the valuations are okay, how do future earnings look, and then take a call. At a
mm,
house level, we are positive on financials. We are
mm,
very positive on discretionary, which would benefit in the recovery period, and some relative stable sectors like healthcare, IT, we believe will see a structural growth pattern, and there are some B2B businesses which will benefit. And we do find some very good value names across the sectors. Some PSU names look good to us. So it's not restricted to one or two sectors. We see a fair amount of opportunities across the spectrum of the market.
So, when we hear about reflation, there's a lot
Yep.
of talk about airlines benefiting, hotels, tourism, and also, on a broad category, fund managers talk about small caps. So, how does this link in?
So our view is a little interesting. If you track our portfolios, we've been very much a large and mid cap sort of portfolio outlook rather
Mm,
than small caps, because there is this very interesting observation by us saying that when there are value picks in the mid cap segment,
mm,
why take the risk of small caps has been our view. Does not mean stocks are good or bad. That we refrain from commenting on that. But look at what's happened to the present scenario. The present scenario has definitely given a shift to the larger players. Automation has prevailed over labor. And clearly, as I was telling you, there's a clear distinction between, staples and discretionary. What has happened on the financial side is unbelievable. And that's unfolding as we speak, the digital payments and all that. So, companies which have those plays, and when you compare, say, the larger companies of India with the larger companies of the world, the gap is massive. So when you look at it from a risk reward perspective, we feel there is still a lot left in the growth in the large companies, and there are enough value picks in the mid-cap side of the market. Hence, we try to stick to that part in our portfolio. And the small caps come with their own issues of market cap, free float. So we try to keep away from that, not taking anything away from the opportunities there. But we find enough value within the top 250 stocks. So we'd like to stick to that as of now.
Sure.
But as you rightly said, some of the recoveries there are waiting to happen.
Yeah.
Some of the good balance sheets which have taken a hit due to the environment around us due to COVID. And there is a lot of work at the underlying which is happening. And there's a clear shift. If you see, the largest corporate of the country announced a very big clean energy project.
Yeah.
And there's a definite shift to the ESG factor. There is no denying the fact that the environment and climate are beginning to have an impact. So all this then throws up very big opportunities within the large companies also.
In fact, you spoke about banking in India, and it's not just in India, but globally, there is now a lot of focus on banking, financial services as the segment to be in. As
Sapnath, 3.5 years ago, we launched our health. Sorry, I'm sorry. This is just an example, not talking about the funds or anything. When we launched our healthcare fund 3.5 years ago, we said this is the time to buy it. And we were saying that this is probably the best time to get into healthcare because of the prices, and see how healthcare is unfolded. We're probably at a similar place with banking at this moment, with so much to happen. But the new banking will probably, at some point, I dare say, may not have any correlation with the banking which is happening now. Such is the disruption happening in that, and that's making banking such an exciting place to play, and for the existing bankers to adapt to this and revive those business models is also so good to watch. A lot of them are doing it, and it's fascinating, that space.
Yeah, these digital banks that we hear about, China already has a few. I mean, there are no branches, there's no nothing. The entire huge bank is just in a cloud. So
I must tell you, if you go to Seoul or South Korea, the bankers are relegated to cafes.
Okay.
Yeah, so because that is the only place they get to meet the customer. So you will have a large cafe with a bank in the corner with one employee. That's what banking has become, and it's incredible to see. And that's what I say, the new age banker will be very different from what used to happen. You come from a banking background, and look at those classical banking days and what's it become now. I mean, the interface is completely changed, and it's fascinating.
Yes. So the 10th and last trend that we would like to highlight is something that is affecting all of us in our lives. We are seeing it on a day-to-day basis, and that's the digital revolution. In fact, a new data era. So apparently in data, they say that a new computing cycle emerges every decade, and this gives access to computing which increases by 10-fold than what it was earlier. And COVID has accelerated the current cycle. So this presents huge opportunities, not just for the tech sector, but also early adopters in healthcare, in financial services, and so on and so forth. And in this entire digital revolution that is happening globally, there is a lot of talk on emerging markets. And emerging markets have emerged as the early adopters or as the leaders in this digital transformation. So, Swaroop, what is making emerging markets stand out in this digital transformation? What are the investment opportunities this throws up?
See, let's look at the globe. And when it comes to data or digital, this thing, a lot has to do with the manpower. We are the youngest nation of the world, producing the highest number of engineers or qualified people for this segment. That's a reality. That's not taking away anything from anybody, but this is a fact. The European countries, or for that matter, US, are all aging people. And the new kids are not taking to data as the Indian is taking. For that matter, the Chinese also taking it. But when you compare it to the developed countries within ourselves, say the Koreas or the Japans of the world, we are way ahead in the first factor, that is providing the people who will enable this. And that's, I think, a big advantage. Where I feel, and it's a personal opinion, is where we could have hit it bigger is by becoming the true enablers. While or owners of this data, I'm sorry, but we are just enablers. We are good service providers. Unlike, so when you do it, like look at the US, they are the owners of this. I mean, and when you look at technology today, it is being divided into two parts. One is the normal technology companies, and then you have the disruptive technology companies, which invest heavily in themselves to make themselves redundant. In the last few years of and of course, COVID is the biggest enabler, and that sort of changes everything. And in this last 1.5 years, our dependence of leading our lives from our smartphones is now a given. So everything now verges on the smartphone for all your needs. I mean, today people are selling cars to houses on the phone. That's a reality. And this is only going to compound once you get... See, for me, life changed when I saw my wife buying vegetables online.
Yeah.
That's something which I could have never thought of. But today it's a given, right? And in this given period is just a 1-year factor. So when you look at it from the emerging market perspective, this is where we come into play. And then especially we talked a little bit about banking, how banking is evolving completely into data. And then when you look at data, there are two big things. What is the big data which is emerging, and of course the analytics which is emerging. And when it comes to these two factors, make no mistake, the Indian mind is superior analytics than the rest of the world. This I vouch for. So the two big trends or the mega trends that are emerging, maybe the owner might be somebody else, with the underlying manpower or the person providing or the outsourced person. When the manufacturer used to go to Taiwan and all those countries, will come to India. And then there's no reason why probably all the asset managers predict that this is a structural growth path for our IT companies. But look at what is happening at the underlying. The underlying situation in the life is changing. And then this is where, it throws up huge opportunities for Indians, and a lot of this Indian opportunities come in the early stage part. So no wonder that this is also a big boom for the venture capitalists or the PE people. And I'm seeing a lot of penetration into the average individual Indians through a scope in investing into a lot of companies. I'm sure you must have a lot of investors who are now getting into the early stage investing and seeing some of them actually materialize into an exit. So point I'm making is that due to data, due to this whole thing of digitalization, the avenues are just increasing from banking to hotels. There is nothing that is going to be spared, and the enabler will be data. I mean, who could have imagined, say, the Ola and Uber stories are already extinct. They are old stories. What will emerge now is digital payment. What will emerge now is credit. India is not a leverage country. We feel scared taking loans. But the kind of companies which are coming to leverage you up through digital means, we are seeing such a huge revolution in the demat side of the story and broking revival happening as we speak. I do believe that most of the broking investors are not just trading in stocks. I believe it will lead to a huge penetration of mutual funds through the passive route through that. So the avenues that are increasing are endless. I can speak for 2 days on this subject and still be left with more to say. So when you look at digitization, what you rightly said is, number one, yes, COVID has been the enabler. There is no denying that factor. But the other factor is the emerging markets, by the virtue of their potential, are also rising to the occasion. We will, at this moment, which is my only grouse, is that we are not yet disruptive in nature. I wish we make that trend and own some of those disruptive technologies, which we are capable of, but maybe we are not suited for that, whatever be it. But we will be very good enablers, and there lies a lot of potential. And the future is only incredible, not only for India, for a lot of emerging markets of this planet.
So in a way,
I suspect even in the emerging markets, you will have an Indian sitting there and doing this job.
yeah. So in a way, the lack of infrastructure in emerging markets has actually, and the need for services that has actually pushed this trend forward. So whether we see India or Thailand or Malaysia, all these countries, there is we have jumped over a decade of progression, which we
I'll give you two significant data. We are the only country, and now probably some are there, who are biometrically recognized.
Yeah,
right.
Our is
and look at our size. When you put this thing, put the size in place.
Yeah.
You are recognized by your fingerprint everywhere. That is digitization at a different level. The COVID or the vaccination drive across the country is digitized. You have to register on the COVID platform to actually get a jab. That is not how it works in the rest of the world. The rest of the world is still physical. So when you combine these two and look at the sizes of what we are doing, and then you reflect on the servers which are handling this, no wonder the COVID server collapsed. One very important part which I missed out when it comes to the servers. The other part which is emerging, which is also, along with digitization, is the security of this data. So some of the part which will emerge are cyber security is a huge area which is emerging. Cyber insurance is a huge part which is emerging. And just the hardware spaces for these, maybe it will digress out to be the cloud, but there is some upgradation happening. So when you look at the overall picture, there is no area which is not being enhanced. It's incredible. You can just go on thinking.
Yeah. So actually this early and fast adoption of digital is also one of the probably key drivers for emerging markets. One of the key things, like you were talking some of the countries, recently so much talk about Taiwan being one of the biggest manufacturer of semiconductors. It's so much.
Because they had invested so much in that, suddenly they are in play. I remember when company comes from South Korea, so they will always say that, okay, fine, buy how much iPhone you want. Finally, you will use our conductors only. So they will always say that. So the investment, the investments which went in earlier into these areas is benefiting them now.
Yeah. So Swaroop, this brings us to the end of our discussion. We'll now have a Q&A session. So I have a number of questions on my screen. The first one is, in the recent Fed policy meeting, the central bankers have indicated that they were looking at 2 interest rate hikes towards the end of 2023. So this is a year earlier than projected. What are the implications of this for India?
See, as we reflected earlier, so if the trend of this benign policy continues and inflation is on a sustained basis, it could be reversed. And there's a possibility of that happening. Then, there is a cascading effect of the currency, the oil, and as I mentioned, and as we discussed, all these augurs well for emerging markets. Because, we get to pay off our debt easier, and hence the scope to do the other things sort of widen. Everything opens up for the emerging markets. And make no mistake, this will be for a short term. There will be a short window, and hopefully we as a country take that window as an advantage, which I think all of us are gearing up. And if somewhere, personal opinion again, if at that point of time there is some, like other countries have come in and put some cash on the table to cover the corporate size, if something like that happens in India, then the capex market of the Indian cycle could also go up tremendously. So if any kind of can lead to some change in the movement of money, but when you reflect on the last rally, and let's get a little get into a little bottom of it, is that there is a reason why so much of money is coming to India, and it's coming from that side. right? This is anticipating all this and keeping India in mind as a ready country to take benefit of that.
Right.
And there is talk that markets will correct, not correct. There's a lot of talk on that. Trust me, even if markets correct or not, there are 50, 60 good opportunities for any fund manager to give you a good portfolio. And most of those opportunities will come due to this. So it doesn't matter on the overall market. Sometimes we get caught in the macro part. We forget that, a fund manager needs just 50, 60 good ideas. And due to this, there will be 60 ideas and more to build a portfolio. And that's something which anybody investing should focus on. Are my 60 companies or the 50 companies that I'm owning through my fund manager, are they ready for this or not? It'll play a big factor.
Okay. So the second question is, there's been a lot of talk about China plus policy in the last 1 year. What are the prospects for India as compared to other countries like Bangladesh, Vietnam to take advantage of this global trend?
See, I think anything which deviates out from there comes here, right? Right. But you must give credit to countries like Bangladesh, which have picked up one or two factors like textiles and all, build their economy around it. I'm a big fan of Michael E. Porter, who says that, if you have a competitive advantage, stick to it. And if you look at countries across the world, you look at Switzerland, probably free because of just chocolates. It can become a free economy just because of watches, though we concentrate on Swiss accounts. That's not their main avenue, just on one product. They're free. Though very difficult to predict that with countries. But if you break down India into different states, I believe every state could have one product like that. And that's what Bangladesh has done. I don't think Pakistan is a big issue, but Sri Lanka is, in my words, half Chinese already. So let's keep Sri Lanka out of it, because the infrastructure of Sri Lanka is practically Chinese. And thankfully, we have not done that. So I'm a big proponent of a free economy. Some of the curbs that happened due to this China factor in the middle of the beginning of the pandemic today are helping, again, giving that opportunities to some Indian promoter to start building them on their own. And look at what's happened in that space. Some of the big early stage tech providers are beginning to gain some importance. So anything that happens at this moment will only be good for India. But I come with a big rider on this. Then the onus shifts on India. Then just policy making will not help it. Where we have seen, and we've always flattered to deceive, is the implementation of the whole thing. And
policy
you have to follow it up with doing it. And that's where the test then will be there. Like I said, the window will be very short and very small. And in that window, if India can take, and I hope we take, because we want to do it, is from the thing that I get from all around. So the rider that I bring to the table is that the opportunity will be there, but it is up to India to take the opportunity. Our past record is not on our side on this one.
Okay.
So that's the only rider I leave. Otherwise, things are set for India.
Okay. The next question is, the finance ministers of G7 countries have decided to impose a minimum global tax of 15% on multinational companies. This has been talked about during this recent G7. This is basically to prevent mega tech companies from avoiding taxes by moving to different jurisdictions. So now tech companies have been a major driver of global equity indices in the last years. What is the implication of this policy on investment landscape if it is implemented? So basically asking, with the 15% taxes imposed on all the Googles and the Facebooks of this world, do you see it having an impact on the investment landscape?
So see, we just did some of this. Let's put some sizes in perspective. We just did, and this is what I learned in the last 1-2 years. When you look at the FANG Plus companies, and their market cap, those 10 companies' market cap is 7.7 trillion, which is 3 times India.
Yeah.
Okay. Their market cap is, bigger than our entire market cap put together. So we are talking about companies at a different size, and it's not that they will not fight back. It's not that they have enough lever now across the globe. 15% could be a little harsh, but it is a fact that if you're doing it to, subvent taxation, that is also not correct. They've become so large that, these could be beyond them at this moment. When you look at it from a global perspective, 7.7 trillion is not a joke. So we will wait and see how this space unfolds. If they will say something, trust me, these companies are big enough to also say things on their own. And let's see how the world reacts. But I don't see that as a factor at all. They've gone beyond a lot of these things. But when you look at these 10, 15 companies, the beauty of these companies is, yes, I do agree that any sort of tax evasion should be plugged. Right, that's a given, and I'm sure they will find a reach. But look at those companies, the way they reinvest in themselves to disrupt themselves is something which is alien only to them, or just restricted to them. So while there will be talk, and a lot of this talk hinges on the political side, let's be very honest on that, they will also take 2 steps back, and there will be an understanding for sure. I will not say more than that.
Yeah.
I mean, there is a lot of talk on one particular company in India with the powers to be saying that it should not be in India, but it's still in India, no?
Yeah.
If you have to reach out to people, you reach out to people through Twitter now.
Yeah, yes.
So if you take Twitter out, that part also goes. So who will take that risk? So it's not that they're small is what I'm saying.
Yeah. So we've run out of time. This brings us to the end of today's session. Thank you, Swaroop, for your time and some really great insights. I'm sure everybody's found a few takeaways from today's discussion. I'd like to thank everyone for your time and joining this session. And I request you all to take out 30 seconds to fill the feedback form, which will appear on your browser as you exit this webinar. Thank you once again. Take care and stay safe. Bye.
Thank you so much, Swapna. Bye-bye.
Bye.